Welcome, everybody, to the SNN.Network virtual conference. I'm your host, Robert Kraft. You might also know me as the host of the Planet MicroCap podcast, as well as the SNN.Network YouTube channel. I'm really pleased that you're joining us today, not only to participate in our conference, but we have an incredibly special keynote guest that's about to grace your screen. Well, he's already graced your screen. This is a split screen, so you can see him actually. But I'm very excited.
That guy? Who is that guy?
But so I'd love to introduce our keynote speaker, very special keynote speaker. It's Jim O'Shaughnessy. He's the principal chairman and co-chief investment officer and portfolio manager at O'Shaughnessy Asset Management. As founder and co-chief investment officer of the firm, Jim is ultimately responsible for OSAM's investment strategies. No pressure there, but you've been dealing with that for 30 plus years, so you're used to it. You know, Jim is an equity owner in OSAM and a member of the firm's executive committee. With that, pleased to introduce Jim O'Shaughnessy. Jim, thank you so much for doing this.
Great to be here, Robert, and hello, everyone. I'm delighted to be here to talk a little bit about where we see things going, and especially given Robert's love and passion for microcaps, very similar to my own. That's actually how we hooked up. We'll make it a little tailored to that part of the market. What's interesting, Robert, is we tried to do this earlier, right? And I was on Nantucket with my family, which was great, but no internet. And sometimes no internet is cool because you just got to sit and think. And so before trying it that first time, I started to think about what I wanted to talk about. And the thing that just kept striking me was the framing that you put around your investments really, in many respects, is going to help pretty much determine your outcome. And by that, I mean, individual investors have such an advantage over pros because you can make your time frame whatever you want it to be. Pros often have to look at every quarter, every year, every 3 years, certainly. And that's a real disadvantage, I think, for many professional investors. We're lucky in that we're quants. And so as much as we would love to override when we have a horrible quarter, and we do have horrible quarters and years, we can't do it, which helps us save a lot of worry and consternation. But one of the things that I was thinking about was, man, what if we were doing this in late February, early March of this year? We would have been in a market that was going down vertically, right? With people quipping, well, it can only go down another 1,800 points, 18 more days, and then it gets to zero. And generally speaking, in those kinds of market environments, what happens to us is our emotions simply take over. We're human beings. I'm no different than you. Robert's no different than you. We're all the same. We are all programmed the same way. And during times of, real panic, unfortunately, we tend to react the same. That's why you see kind of the majority of people selling near or at market bottoms, and the majority of getting excited about things at or near market tops. We're programmed really to fail as investors because evolution had different ideas for us. It was just trying to keep us alive. And that was one of the things that Robert and I chatted about in another conversation. You look at human evolution, everyone on this earth today is descended from cowards. We are descended from the people who saw the bush moving and ran away, right? We didn't say, oh, I wonder what that is, and got eaten by a saber-toothed tiger. So it's natural. It's absolutely natural. And if you can understand that you're not different, you're just like every other human, and then you can put a process into place that tries to modify your behavior to take advantage of that knowledge, what I call arbitraging human nature, you're in a position as an individual investor to do things that pros simply can't do. So back to February, early March. I often tell people I'm 60 years old, right? And I've been doing this a long time, and I have children, grandchildren, and people will say, well, why do you love microcaps? They're so volatile. I mean, shouldn't you be mostly in bonds, right? Because isn't it 100 minus your age? So shouldn't you have just 40% in equities for 60% in bonds? And my answer is I learned something from my first big client at my first firm, O'Shaughnessy Capital Management. He was a prospector, a gold prospector, who did very well and sold his company to a big gold concern out of Toronto. And he had read my book. And so he called me and I said, please come down. I want to discuss you managing my money. And so I made the flight to New Mexico. He was just everything I anticipated he would be, a salt of the earth kind of guy. And I start pitching him. He was 70 at the time. And I started pitching him on our most conservative portfolios. And he got this wry smile on his face. And he goes, I want to stop you right there. And I said, okay. And he goes, why are you pitching me this conservative stuff? And I said, well, you know, you're 70 years old. And he got a big smile on his face and pointed to the side table, which was overflowing with pictures of his family, his grandchildren, his friends, and everything. And he looked at me and he said, my time horizon is infinite. And that really struck a chord with me. And in my case, look, I have children, grandchildren, charities that I would love to leave something to when I leave this, shuffle off this mortal coil. And so I have the luxury of having sort of an infinite time horizon. And so do you. That's something you need to really think about. You get to play a different game than professional investors. And that is a huge advantage for the individual. Things like, for example, Robert and I were talking before we started about things like ESG. If you have a particular cause, be it more women on boards, be it more people of color on boards, be it more diversity, whatever your particular thing is, you can build that into your process and into your portfolio, and you're the only one who gets to determine what you want in there. The flexibility that you have as an individual investor is really quite amazing. And you should take advantage of it because, listen, we are, I think, in kind of a golden age for individual investors. You can do things and you can have access to tools and data that, like just 20 years ago, cost millions of dollars and only pros could have access to it. That's not the case anymore. We are literally living in a golden age for you. You really need to take advantage of it. And there are so many tools. Robert is going to enumerate many of them, and he already has and probably will continue to. But the fact is, it's all out there. And we have opportunities as individuals that just did not exist prior to this. But to make it work for you, I'm going to tell you something that you might not like. And that is, you are going to go through pretty incredible pain over your course if you want to succeed as an investor. I used to joke that I got very used to it. I've been at this for 35 years and I'm a professional investor. So it was very easy for me because I went from genius to idiot, genius, idiot, genius, idiot. And that's part of the deal. And the nice thing is, probably in your case, maybe it's only going to be your spouse or your friends who are calling you genius, idiot, genius, idiot. It's not going to be the entire world. But just get used to it and prepare for it, because if you really want to do better than the market, right, you're going to have a portfolio that is very different than the market. I mean, it's pretty basic stuff, but people don't really think about that too often. When you're very different than the market, guess what? You can be doing incredibly well when everything else is doing really poorly. That's your genius part, right? You can pretty much judge it if you go to remember dinner parties? Well, let's hope we get to have those again. So if you go to a dinner party after COVID is done, and people are crowding around you and saying, gosh, I really want to hear about your stock selections, keep in mind that itself is a nice indicator that things might be cooling down for you. But conversely, when things aren't going your way, because when things are going your way, you might get overconfident, you might get a little bit full of yourself. But when you get really challenged is when things aren't going when things aren't going your way, again, back to evolution, everything conspires against us to want to throw in the towel. Because when we look like idiots, when we look like fools, that brings up a horrible feeling. And again, in all of us, no one is immune to this. And so the more you remind that yourself of that, the easier, but I'm not going to try to mince words. It's never easy. But the more often you're going to be able to stick to your guns, right? So microcaps. One of the reasons that I love the microcap market is that scarcity is just offers so many opportunities for individual and professional investors. And boy, the microcap market is the very definition of scarcity, right? The market caps of companies down in microcap land are such that most big professional investors can't even play there. We have a microcap strategy pretty much just because I love microcaps. And yet, we really wouldn't offer it if we were trying to decide, based on, assets versus alpha, right? We've always chosen alpha over assets. And it's a choice that you don't have to make. You can play in microcap land. And so some specifics for that particular space. Number one, don't try to index your portfolio to microcaps, because one of the interesting things about microcaps are the entire universe is pretty awful. I mean, honestly, if you're going to look at the entire universe, what you're going to see is maybe 75% of it is just like really junk that you don't want to be near. But the beautiful part is 20 to 25% of it are diamonds in the rough. And they're diamonds in the rough because there aren't many analysts looking at it. They, for example, our microcap portfolio had, something like at one point, 20% of the companies were taken over. That's another nice little built-in feature to microcaps that, you're not going to get if you buy Apple, right? I don't think anyone other than maybe the Fed can take over Apple. But in the microcap universe, if you have a disciplined process, you're able to find fantastic values that really don't exist in large cap land. They've been arbitraged away in large cap land. And people will often say, yeah, but large caps are doing so much better than small caps or micro caps. And, this seems to be a systematic change in the market. Well, maybe that's true, but then again, maybe it's not. Ultimately, people are not going to let dollar bills just float down the street without bending down to pick them up, right? They might for a while, if it's raining or they're in a hurry or whatever, they might let that dollar bill just float down the street. But generally speaking, they're going to bend down to pick it up. And if you got there first and you picked it up, you get to sell it to them for maybe more than $1. And that's what we're after in microcap land. You have opportunities that really are pretty much just specific to that part of the market. Now, of course, there are emerging markets, there are frontier markets, et cetera. But when you have such a huge universe right here in the good old US of A or Canada or some of the markets that we know really well, why not take advantage of it? So I guess my message is it really doesn't matter what the overall market is doing. The more you check your portfolio in terms of how it's doing, think about it this way. Imagine you bought your house 10 years ago and every day you found out from a realtor what your house was worth. It would drive you crazy. Because essentially, if your house declined by 20% in a quarter, you might say to your spouse, we got to sell. This is just going to keep going on. Well, obviously, we don't look at real estate that way. We don't look at houses that way. And generally speaking, while I don't advocate being a pure real estate investor, it can be a pretty reasonably good investment over long periods of time. The same is true in microcap land and small cap land. But you've got to have a plan. Don't go into it don't go looking at a great story and saying, oh, wow, this looks great. I'm just going to buy that because I like that story. You know, when you put it like that, people would say, well, I would never do that. Well, the answer is yes, you would. So would I. If I let myself do that, again, we're human beings. That's the kind of things we do. We love stories. And I'm not saying that you shouldn't pay attention, any attention to the story. Sure, pay attention to the story, but then look at the specifics. Use these tools that make this a golden age for the individual investor and find a great story where the numbers are saying, wow, this is not only a great story, this is a fantastic story. Are you always going to be right? Nope, you're not. You've got to build into the equation the fact that you're going to be wrong X% of the time, right? And, you know, people who do really well in, say, things like gambling or betting, there's a reason why the house builds those beautiful casinos, right? The odds are just this much in their favor, but they compound that over time, and that's what gives you the Bellagio, not the guy walking in the front door, right? So try to think like you have the ability to be the house. You're going to be wrong a certain percentage of the time, but as long as you find a process that works well for you, and that's the other thing I really want to stress. People often ask me, well, Jim, you know, what should I do? Give me the formula, right? And I say, well, there is no one formula for every single investor. Everybody is different. I wrote a book called What Works on Wall Street, where I show you how things have performed, how various factors have performed over long periods of time. But you've got to personalize that to you. Because, you know, one of my first big mistakes was designing portfolios for me. And I have a really large tolerance for risk. And I realized when things were going well, it seemed like everyone else did too. But then when you get to the other side of risk, the unhappy, unfun side, you realize very few people had that kind of tolerance. So what you really need to do is kind of sit down, talk it over with loved one, talk it over with spouse, because another thing from behavioral finance that we see that's really interesting is we're really good at seeing another person's problems, but we're really bad at seeing our own. And so that's why we get into all this trouble that we get into when we're trying to make decisions. So if you want to play a game, pretend you're someone else and then start saying, or start with a friend, you know, Robert has problems A, B, C, and D, right? And then guess what? The problems you see in other people are probably reflections of problems you yourself face. Those are the ones that always jump out at us. And it's because we have a little queasiness about our own problems there. The point being, determine something that's going to work for you and you alone. Again, you don't have to craft this to anyone else. You might like microcaps, but be really risk adverse. Well, that means that you're only going to put X% of your funds, your investable funds, in those kinds of names. You might be, crazy and love risk, and then you're going to do something very different. But the key thing here is that, again, because of the tools that we have available today, you can personalize everything to you. We've really never been in that kind of market environment before. And so you can take advantage of it right now. What you need to do, though, is be honest, look at your past behavior. That is a really good indicator, right? So the financial crisis of 2007-8, what'd you do? Did you sell near the market bottom? Did you sell a lot? Or did you buy? Look at what you can't change, right? Your previous behavior. And then understand that, guess what? You're probably going to do something similar if we face a similar crisis in the future. You know, there's that old saying that the best way to determine what somebody is going to do tomorrow is to look at what they did today and yesterday, right? We try to be very consistent in our actions, our thoughts, and our deeds. And sometimes that's great, but sometimes it gets us into trouble. So I guess in closing, what I would say is the opportunities really are endless for the individual investor. We live in a time where you can do things that even the smartest individual could not have done 30, 40 years ago. But the thing we've always got to deal with is our human nature has not changed at all, right? So I always say the four horsemen of the investment apocalypse are fear, greed, hope, and ignorance. If you think about that, fear, greed, and hope are all emotions. Only ignorance is not an emotion and can be addressed. But fear, greed, and hope have wiped out more portfolio value than any bear market in history. And so the more you can really internalize that, the more you can, and I always advocate, write it down, because our brains think they're doing us a favor, but they're really not. They make our memories change based on what we think now. I know that's hard to believe, but if you start keeping a journal about your investments or about anything really, and you go back and you look what you were actually writing, you're going to find yourself in an argument with yourself, because you could swear, if you were in a court of law and you had to swear on a Bible, yes, this is what I did or believed back then, and then you go look at what you wrote, you'd be committing perjury quite a bit. So understand that, you know, the old Pogo cartoon that many of the people watching this are far too young to even remember, but it was a popular cartoon a long time ago, and Pogo was this little animated character who said, "We've met the enemy and it's us." That hasn't changed. And so the more we understand that really the last sustainable edge is to arbitrage our very own human nature, the more we can start getting these things lined up and create a process that works for you. So with that, I will say thank you. Have a great summit, as virtual as it is. And Robert, thanks very much for having me.
Thank you, Jim. One quick follow-up question before I let you go.
Sure.
And I know a lot of our audience watching this are probably asking, you know, Jim, you've been through the 87 crisis, the dot-com bubble, the GFC, and now we're dealing with COVID, where it was the fastest potential recession, now recovery. I mean, as a human yourself, I'm pretty sure, even as a quant, I'm pretty sure, you know, what was some of your emotions that you were going through, and then were able to kind of reconcile with based on some of your past experiences?
Great question. And actually, I wrote a piece, I'll send it to you, that in hindsight was one of the best things that could have ever happened to me. When it happened to me, it was one of the worst things that ever happened to me. And it concerned the 1987 crash. Going into the 1987 crash, I was 27 years old and, you know, knew what I was doing. I was using much different methodology back then. Some of the same things, but very different than what I do now. But I had amassed the biggest put position that I'd ever had in my life going into the crash. And I sold them all the day before the crash. And when I went back and looked at what I wrote, it made me realize about 6 months to a year, because that was a really stinging thing that happened to me, because you know the drill. You imagine, you look at the price and see what you would have gained, and it really stings. But for me, it was the eureka, aha moment. I saw that I was, in fact, just as human as everyone else. I was not smarter. I was not, you know, braver. I was just like everyone else. And that is what made me decide then and there that what I really needed to do was put a system in place that allowed me to sidestep those emotions. So to your question, yes. What was I concerned during the great financial crisis? Absolutely. Was I concerned during the crash, during the dot-com? But I had trained myself. So for example, in March of 2009, I wrote a piece called A Generational Buying Opportunity. Most people thought, you know, you've been out in the sun too long, O'Shaughnessy, you're crazy. But the fact is, when you condition yourself to kind of think the opposite over long periods of time, you start doing it. And so when the market was going vertically down during the first part of the year 2020, I was, of course, nervous. Like, who wouldn't be? This was something that we hadn't faced since the early part of the 1900s, a pandemic that was going to shut down most of the US economy. Very, very scary stuff. But then I reminded myself, okay, I don't know what's going to happen here. I do know a couple other things, though. I do know that if I detach myself from the here and now, right, and let the past, present, and future become mine now, I do know that the US had faced far worse and come back from it. I did know that, Churchill, a funny thing was, he had a saying that was, Americans will always eventually do the right thing, but only after trying every conceivable alternative. Well, but the fact is, that's funny, but it's true. We always end up rolling our sleeves up and tackling whatever's in front of us. And everyone says, yeah, but, and then they insert whatever the controversy of the day happens to be. Well, a lot of people, if you don't understand that America's gone through even more tumultuous times, Google 1968 Democratic Convention. Google anarchists of the early 1900s. Boy, a lot of stuff went on in this country that we bounced back from, and we're going to bounce back yet again. Again, we're privileged to live where we live, where we still have the rule of law, where we still have the freedom of expression, where we still have the ability and gumption to roll up our sleeves, like a lot of those microcap stocks that you're looking at, and think about the longer term. So the answer is, yeah, I'm a human being. I was scared. I was worried. I was everything most other people were. But another part that I haven't mentioned yet that helped me through that was I read a lot of history and I read a lot of philosophy. And the Stoics were Greek and Roman thinkers who basically had this idea that you shouldn't waste a minute of your emotional energy on something that you yourself can't change, right? So it's hard because, again, we're humans. But the more you think like that, and the more you think, well, we'll see. We'll see. What does history teach me? History teaches me that the probability is definitely on my side that says that we're going to make it through it. Could I be wrong? Sure. Of course I could be wrong. A comet could hit the Earth tomorrow and then game over. But the fact is, that's probably not going to happen. And since that's probably not going to happen, I like to look at the very, very long and wisest counselor, time. Pericles said that a long time ago, but he was right. And so, yep, you're going to get nervous. You're going to listen to people. They're going to really sound convincing. But then just remind yourself, okay, what happened after all these other crises? We came back, went on to new highs.
I think that's a great place to end it. Jim, always a pleasure. Thank you so much for sharing your thoughts today. That was fantastic. And where can everybody watching this go and find more information about you? And then also you have a new well, it's not new anymore, but where can people go and listen to your podcast?
Sure. So you can see me on Twitter at JP O'Shaughnessy. www.OSAM.com. That's my company. Where you can, if you're a nerd, you can find a lot of very nerd-like papers and research. You can also listen to me chat with really fascinating, interesting people on Infinite Loops, which is available on all major podcast platforms. I think that's enough for you to really get sick and tired of me.
It's impossible. Are you kidding? Come on. Well, Jim, thank you again. And I look forward to our next chat.
Awesome. Thank you, Robert.
Thank you.